What if I told you that the silver market is moving toward a moment where paper contracts are rising, but the physical metal behind them is quietly shrinking? What if the real pressure is not on the price chart, but inside the vaults? Right now, something very important is happening in the silver market, and most people are not paying attention. The focus is on daily price moves, but the real story is about delivery, inventory, and timing. And this is where smart investors must look deeper. Welcome to Gold Silver Scope, where we break down gold and silver in simple, clear language so you can understand what is really happening behind the scenes. Let's start with how silver delivery works on COMEX. When someone buys a silver futures contract, they are not immediately buying physical silver. They are entering into a contract. They pay margin, not full value. Now here is where it gets interesting. If that investor holds the contract into the delivery month and does not close it before the first intent date, they can be selected to receive physical silver, but they don't control the timing. The short position controls the process. This is very important to understand. The short decides when to file a notice of intent to deliver. Once they file that notice, it is matched randomly with one of the long holders who is still open in the delivery month. It could be any long. It is almost like a lottery system. The long does not know the exact day they will be called to pay the full amount. But once matched, they must pay in full and take delivery. There is no delay and no negotiation. The first intent date for the March silver contract is February 26. That means if you are long and still holding your position at the end of February, you are signaling that you are ready to take physical silver. After that date, at any moment, you could be matched and told to pay the full contract value. And once the short files the notice, they must deliver within 2 business days. So the process moves quickly. Now here is why this matters so much. The number of open contracts suggests that a large amount of silver may be standing for delivery. At the same time, the amount of registered silver available inside the exchange warehouses has been falling steadily. Registered silver is the metal that is officially available to meet futures delivery. This is the pool that matters most during delivery month. Just a few months ago, registered silver was around 160 million ounces. Recently, it was around 110 million ounces. And now it has dropped below 100 million ounces. It is currently sitting near 98 million ounces. That is a sharp decline in a short period of time. And the trend has been downward for months. Yes, there is also eligible silver in the warehouses, which is over 280 million ounces. But eligible silver is not automatically available for delivery. It belongs to owners who may not want to sell. It must be converted into registered status before it can be used for futures delivery. That means we cannot assume all eligible silver will step in to solve a shortage. Recently, about 3 million ounces were moved from registered to eligible. That means someone chose to remove silver from the deliverable category. It can move back, but the direction of the trend is what matters. And the trend shows that registered inventory is shrinking. If this continues, and if the projected demand for March delivery is around 120 to 130 million ounces, then we may be looking at a serious imbalance. If only 70 to 80 million ounces are registered by the time delivery begins, but over 120 million ounces are demanded, then the pressure on the system increases. Now let's also look briefly at price action. Gold has been strong over the past 6 months, trading close to major highs. Silver had a powerful surge earlier, reaching well above the $100 level, even touching above $120 at its peak. But then we saw a sharp drop, likely triggered by heavy stop losses and aggressive selling. After that, the price recovered somewhat, but it remains well below its peak. Meanwhile, in Shanghai, a major silver fund suspended new creations. That usually happens when physical metal is not easily available. When a fund cannot create new units, it often trades at a premium to its net asset value. At one point, That premium reached extreme levels, close to 100%. That tells you there was strong demand for exposure to silver, but limited physical supply to back it. When we combine falling registered inventories, strong delivery interest, and signals from overseas markets, we begin to see stress building under the surface. And the key date to watch is February 26th, the first intent date. After that, everything accelerates. Now let us go deeper into what could happen as we move into the March delivery cycle, because this is where pressure can build very quickly. As we discussed, the first intent date is February 26th. From that day onward, any short holding a March contract can file a notice of intent to deliver silver. The moment they file that notice, the system randomly matches that short with a long who is still open in the contract. The long does not control the timing. The long simply waits in the delivery pool. This structure gives power to the shorts in terms of timing. They decide the exact day to initiate delivery. However, once they file the notice, they cannot delay. They must deliver the metal within 2 business days. So if they file on February 26, the delivery must happen by early March. If they file later in the month, the delivery simply shifts forward by 2 business days from that filing date. Now think about the situation we are facing. Open interest suggests that a very large amount of silver could stand for delivery in March. Let us assume the number is around 120 to 130 million ounces. At the same time, registered silver has fallen below 100 million ounces. Even if it is sitting at 98 million ounces today, the trend has been downward, not upward. If this downward trend continues, registered silver could fall to 80 million ounces or even 70 million ounces by the time delivery pressure begins. That creates a mathematical tension. If 120 million ounces are demanded, but only 80 million ounces are available in registered form, something has to adjust. There are only a few possible outcomes in this situation. First, more silver could move from eligible to registered. Technically, this is possible. There are more than 280 million ounces classified as eligible. But remember, eligible silver belongs to private owners. It could be owned by exchange-traded funds, institutions, sovereign funds, or private investors. These owners are not required to convert their silver to registered status. They must choose to do so. If they expect higher prices, they may prefer to hold rather than convert. Second, some longs may close their positions before taking delivery. This would reduce actual delivery demand. Many futures traders do not want physical silver. They simply speculate on price. If they see tight conditions, some may exit their positions and take profit instead of demanding metal. That would reduce pressure. Third, the price of silver could rise sharply. Rising prices can encourage more silver to enter the system. If the price jumps high enough, it may motivate holders of eligible silver to convert to registered and sell into delivery. Price is always the balancing tool in commodity markets. But here is the key issue. If registered inventories are visibly shrinking while open interest remains high, it sends a psychological signal to the market. Traders begin to ask, is there enough silver? Even if there is technically enough metal in eligible form, confidence becomes the real factor. Markets move not only on supply and demand, but on expectations. If participants believe that physical supply is tightening, they may rush to secure positions early. That alone can create volatility. We also need to understand that the delivery process spreads across the entire month. Shorts do not need to deliver everything on the first day. They can file notices gradually. They might even wait, hoping that some longs close their contracts voluntarily. If longs reduce their positions before filing notices are issued, pressure on inventory eases. However, if a large number of longs remain open after February 26th, that is a strong signal. It shows that many participants intend to take physical silver. That is when tension increases sharply. Another important factor is the speed of inventory decline. Registered silver has not fallen slowly over years. It has dropped significantly in just a few months. That tells us that something structural may be happening. Either more investors are demanding physical silver or less metal is flowing into the exchange system. At the same time, we saw earlier that silver prices experienced a sharp surge followed by a fast drop. Such moves often trigger stop losses. Large players sometimes push prices down to trigger those stops, allowing them to buy contracts cheaply. After that, price stabilizes and begins to recover. This type of volatility often happens in tight markets. If we step back and look at the bigger picture, gold has remained relatively strong near major highs. Silver, historically, tends to outperform gold in strong bull phases. When silver begins to tighten physically, price reactions can be very aggressive because the market is smaller and more volatile than gold. Now combine all of this: falling registered inventories, high open interest, delivery month approaching, and strong global demand signals. The situation becomes sensitive. It does not guarantee a shortage, but it increases the probability of price instability. The critical moment is not just the first intent date, but the level of open interest that remains after that date. If open interest stays elevated and inventory continues to decline, the market may respond sharply in March. Now, let us bring everything together and talk about what this could mean for the silver market in the coming weeks and months. When we see falling registered inventories, strong open interest going into a delivery month, and global signals of tight physical supply, we are looking at a market that is under pressure beneath the surface. It may not always show immediately in the price, but pressure builds quietly before it releases. If March begins with registered silver near 80 million ounces while potential delivery demand is above 120 million ounces, the market will be forced to adjust. That adjustment can happen in different ways. Either more silver flows into registered category, or longs reduce their demand, or price rises sharply to balance supply and demand. In commodity markets, price is always the final balancing tool. The most important number to watch is open interest at the end of February. If open interest drops significantly before the first intent date, then pressure reduces. That would mean many traders were simply speculating and chose not to stand for delivery. But if open interest remains high, that tells us many participants want physical silver. In that case, volatility becomes very likely. Remember, the short controls the timing of delivery notice. They can spread delivery across the month, but they cannot escape delivery once they file notice, and they must deliver within 2 business days. If supply is tight, shorts may wait, hoping inventory increases or hoping some longs close their positions. But if registered inventories continue trending downward, the system becomes more fragile. Even if there is technically enough silver in eligible category, confidence becomes the key factor. Markets can move aggressively when confidence weakens. We must also think about global demand. Industrial demand for silver remains strong because silver is used in solar panels, electronics, medical equipment, and many other technologies. At the same time, investment demand rises when investors lose confidence in fiat currencies or financial systems. If both industrial and investment demand increase together, physical supply can tighten very quickly. Historically, silver is known for explosive price moves. It does not move slowly like some other assets. When momentum builds, it can move in large percentages within days or weeks. That is why inventory trends are so important. They often give early warning signals before price reacts. However, we must remain balanced. A tight inventory situation does not automatically mean a guaranteed shortage. Markets are complex. Large institutions can reposition quickly. Eligible silver can be converted. Contracts can be closed. Price can fluctuate both up and down. That is why discipline and risk management are critical. Never assume only one outcome. Instead, monitor the data carefully. Watch registered inventory levels daily. Watch open interest going into delivery. Watch price reaction near key technical levels. And most importantly, watch how the market behaves around the first few delivery days in March. If price rises strongly while inventory continues to fall, that confirms tightening conditions. If price falls while inventory stabilizes, that may signal temporary relief in the system. As investors in gold and silver, our job is not to react emotionally. Our job is to understand structure, timing, and probabilities. Silver is a smaller market compared to gold, which makes it more volatile. That volatility creates both opportunity and risk. If you want to stay updated with deep analysis like this, make sure you subscribe to Gold Silver Scope and turn on notifications. On this channel, we break down gold and silver in simple English, without hype, without noise, and without confusion. We focus on real data, real trends, and real risk management so you can make informed decisions. Before we close, here is a short disclaimer. This content is for educational and informational purposes only. It is not financial advice. Always do your own research and consult with a qualified financial advisor before making any investment decisions. Precious metals markets can be volatile and involve risk. The coming weeks in silver could be very important. Watch the inventory. Watch the open interest. Watch the first intent date. Because sometimes the biggest moves begin quietly, and only those paying attention see them coming.